friends, I'm Melissa Rischel, a licensed mortgage loan originator with Homespire here in Virginia Beach, Virginia. I am licensed in the state of Virginia and North Carolina, and I just want to thank you for taking the time to watch this presentation. In this video, I'm going to be diving into the key factors that go into a mortgage approval. These are the four main things lenders look at, and my goal is to help you understand how lenders think so you can take the guesswork out of getting pre-approved. So a little bit about me. I've helped hundreds of families in Hampton Roads and the surrounding areas go from I'm not sure if we can to official homeowners. I reviewed hundreds of applications, guided loans through underwriting, and celebrated along with clients at the closing table. I created this presentation to help simplify the process, take away the fear, and help you feel prepared and confident when it's your turn to buy. Now, when a lender looks at your mortgage application, they're really looking at four main things. I call them the 4 C's of mortgage approval: capacity, capital, collateral, and credit. Thinking of them like a financial snapshot, together these 4 C's help the lender and you decide when you're truly ready to buy a home. So why do the 4 C's matter? They're the 4 things every lender uses to decide 2 things: whether you'll get approved and what your interest rate and terms will be. And each C tells part of your story. Capacity is your ability to make the payment, your income versus your debts. For example, if you make $6,000 a month and already have $2,000 in monthly obligations, such as car payments or credit card payments, that helps determine how much house you can comfortably afford. Capital is the money you're bringing in, so your down payment, your closing costs, and what's left in your savings after you pay those fees. So say you're buying a $300,000 home and you have $12,000 saved plus a small cushion left over. That just shows the lender that you're financially ready. And then collateral is the home itself. The lender orders an appraisal to make sure it's worth what you're paying. Credit is your financial track record, how you've handled debt before. Even if your score isn't perfect, showing you pay responsibility goes a long way. And here's the thing, lenders don't expect perfection. They're looking for balance. So if your credit score is a little lower, but you've got recent history of on-time payments, steady income and savings, that can still work. And understanding these 4 C's helps you know where you stand now, what you need to improve on, and how to walk into the process feeling prepared instead of nervous. So when lenders talk about capacity, they're really asking, can this borrower comfortably afford a mortgage? And it's all about your income and monthly debt, which make up your debt to income ratio, or your DTI. That's just the percentage of your income that already goes towards payments like credit cards, car loans, student loans, mortgage payments. For example, if you make $5,000 a month and you're asking for a loan that has a $2,000 a month mortgage payment, and then you also have $2,000 in other monthly debts or obligations that you have to pay, that makes your DTI about 80%. And most lenders like that number below 50%, even though it can vary by program and even by lender. Also, if you earn commissions, bonuses, or overtime, lenders usually average that income over 2 years, and they'll use the lower figure if your earnings have dropped recently. So your qualifying income might be a little lower than what shows on your latest pay stub. Understanding how your capacity is calculated helps you to set realistic expectations and start your home search with a comfortable budget. Capacity matters because it's the foundation of a sustainable mortgage. Lenders use it to be sure your loan fits your budget, but also it protects you from becoming house poor. A healthy DTI means you can manage your new payment and still afford life, like groceries, gas, the occasional night out. Capacity isn't just about qualifying, it's about buying a home that keeps you comfortable long after the closing. So improving your capacity is all about creating more room in your monthly budget, making yourself look stronger in the eyes of the lender. And here's 3 practical ways to do that. You can resist your existing debts. by paying down or paying off credit cards or loans, which means you could qualify for more or get better loan terms. You can increase your income. I know it's easier said than done, but even a small raise can shift your numbers in a big way. Lenders take total income into account, and every little bit helps. Avoid new debts during the mortgage process. This is a huge one. Don't finance a car, open a credit card, take out any new loans before or especially not during the process. This increases your DTI and could potentially delay or derail your approval. I also want to make note here about co-signing. Do not co-sign a loan for someone, because that debt and payment history will be included as your own. Unless you can prove that the 12 monthly payments have been made by someone else, we have to count that as your debt. When lenders talk about capital, they're talking about your money in the deal. So your down payment, your closing costs, and any savings you'll still have left after closing. It's basically a snapshot of your financial readiness. Now, the lender wants to know, have you planned for the upfront costs of buying a home? Do you have a cushion left afterwards? So if you're buying a $300,000 home and putting $12,000 down, plus there's about $8,000 in closing costs, the lender's looking to see that you still have some funds left over in savings. That leftover money is called reserves, and it shows you're not emptying your account just to buy this home. Having capital doesn't mean you need to have a huge down payment. Most first-time buyers use 3 to 5% down, and some also get help through down payment assistance programs. So capital is important because it shows the lender that you're invested, prepared, and responsible. It gives them confidence in approving your loan. And when you bring your own funds to closing, it demonstrates commitment. You're not just relying on the bank. You're showing that you've planned and saved for this step. But having less capital doesn't mean you can't buy a home. It just means we have to structure it smartly. So for example, putting 3% down might mean a slightly higher monthly payment, but it lets you become a homeowner sooner while still keeping some money in savings. Capital matters because it's about more than just getting approved. It's about setting yourself up for a comfortable, sustainable future in your new home. When people hear capital, they often think it means you have to come to the table with tens of thousands of dollars, but that's not necessarily true. Here's a few simple tips. You just save consistently. Even a small regular deposit into a separate savings account can add up faster than you think. If you can automate your savings each time you get paid, it removes the temptation to spend it. Explore down payment assistance programs. There's local, state, even employer-based programs that can help with your down payment or closing costs. And these are designed to make homeownership more accessible, especially for first-time buyers. And then you can also use gifted funds if your loan allows it. Many loan programs do allow family members to gift you your down payment or closing costs. Now, it's important to know the rules, but this can be a powerful way to get into a home sooner than you might think. An example of a loan that does not allow gift funds would be an investment property. Most lenders don't allow gifted funds to be used for down payments on investment properties. Now, when lenders are talking about collateral, they're talking about the property itself, the home that you're buying, and collateral is what secures the loan. So if for some reason the loan isn't repaid, the lender could sell the property to recover their money, and that's why they typically order an appraisal to confirm it's worth what you're paying and that it meets safety and condition standards. So for example, if you agree to buy the home for $350,000, but the appraisal comes in at $340,000, you're going to have to either renegotiate the price with the seller or pay the difference out of pocket, because the lender is not going to lend more than the home is worth. Now, collateral is important because, again, it ensures the home you're buying is a sound financial investment, both for you and the lender. The appraisal isn't just about the value, it's about protecting you from paying too much or buying something that could cause problems later. So for instance, if an appraiser finds major structural issues or safety concerns, that could be a red flag that the property might not qualify until those repairs are made. Now, let's say two buyers are each looking at $300,000 homes. One's move-in ready, appraises right at $300,000, no issues. that buyer heads straight to closing, within reason. Now the other property comes back and the appraiser says it needs a new roof and it only is valued at $285,000. Now that buyer is going to have to renegotiate some things and figure out how we're going to get the roof repaired. If the seller can renegotiate the purchase price, and may have to adjust their financing. Now that's the power of collateral. It gives everyone confidence in the deal and keeps your investment secure, your loan realistic, and your new home exactly what it should be: a stable, safe place to build your future. When a lender is reviewing your loan application, they're not just looking at you. They want to also take a very close look at the property you're buying. And the three key things that they evaluate for this is, again, the appraised value, an independent evaluation of what the home is actually worth based on what other similar properties have sold in close proximity to this home in most recently. Lenders want to make sure the home's worth the investment. If the appraisal comes in lower, again, it can impact your loan amount and require some renegotiation. The condition of the property must meet basic safety and livability standards. This is especially important for FHA, VA, and USDA loans. These have stricter condition guidelines. So no peeling paint, no exposed wires, no missing handrails. These kind of issues can delay or even deny loan approval. And then the property type. Is it a primary residence, an investment property, and vacation home? These things make big differences and have different rules, down payment requirements, interest rate risks. Lenders want to know exactly how the property will be used. And we all work together to make sure that the property checks all the boxes for both you and the lender. Lenders talk about credit. They're referring to your financial track record and how you've managed debt and payments over time. So your credit report shows your borrowing history. So credit cards, car loans, student loans, payment patterns. Your credit score is a snapshot of that history. So it reflects how reliable you've been at paying bills on time and how much of your available credit you're using. So let's say you have 2 credit cards with a $5,000 limit each. That's $10,000 in total available credit. Now you've used those cards and you've charged them both up to about a combined $7,000 balance. You're using 70%, $7,000 out of the $10,000 available, 70% of your available credit, which can lower your score. The key is to try to keep that number under 10%, even under 30% can significantly affect your credit score in a positive way. Lenders don't expect perfect credit, but they do want to see consistency and responsibility. So that means paying on time, keeping balances low, and limiting how often you're applying for new accounts. Credit matters because it affects almost everything about your mortgage, from whether you're approved to what interest rate you get. Think of your credit as your trust factor with the lender. So for example, 2 people might both be buying a $300,000 home. One has a 760 credit score, the other has a 640. That difference could mean paying 0.5% more in interest, which could add up to tens of thousands of dollars over the life of the loan. Good credit can also help you qualify for programs with lower down payments, reduced mortgage, or even special incentives for first-time buyers. But if your score isn't where you want it to be, don't panic. Improving your credit is absolutely possible, often in just a few months with the right plan. That's something I help with my clients all the time. Credit's powerful, not just because it opens doors, but because when you understand it, you can control it. Now let's break down what actually affects your credit score, because once you understand these 5 key areas, you'll know exactly where to focus your efforts if you want to improve it. 35% of your credit score is based off of your payment history. So it's the biggest factor. Are you paying your bills on time? Even one missed payment can hurt your score, so staying current is crucial. Credit utilization is about 30% of your credit score. Again, this is how much of your available credit you're using. That 7,000 to the 10,000 available, that 70% credit utilization, that makes up 30% of your credit score. Your length of credit history is about 15%. The longer your accounts have been open, the better. It shows stability. That's why it's usually not a great idea to close old credit cards, even if you don't use them often. Your credit mix is about 10% of your score. Lenders like to see that you can handle a mix of credit. So credit cards, loans, you don't need all of them, but a variety can help. And then new credit is about 10%. So too many credit inquiries in a short amount of time can signal risk, and that can, affect your credit score by about 10%. Now we've covered what affects credit. Here's 3 simple but powerful steps you can start doing right now to boost your score. Pay your bills on time every time. This is the most important thing you can do. Even one late payment can drop your score significantly. So set reminders, auto pay, whatever it takes to stay current. Keep your credit card balances low. Ideally, use less than 10% of your total credit limit. Avoid opening new accounts right before applying for a mortgage. And avoid paying off debts. Paying off some types of debts can actually lower your credit score. For instance, paying off collection accounts or installment loans might not be the best use of your funds or the best plan to boost your score. The most important takeaway is to check with your mortgage advisor and have them complete a review of your credit and create a mortgage-ready plan for you. So there you have it, the 4 C's of mortgage approval: capacity, capital, collateral, and credit. Each one tells a part of your story, how you earn, save, spend, manage your money, and together they help lenders see the full picture of you as a borrower. And the goal isn't to be perfect, it's to be prepared. When you understand how lenders make decisions, you can take small, smart steps that make a big difference, like lowering a credit card balance, saving a little extra for closing, or double checking your debt to income ratio. Buying a home is a huge milestone, but it doesn't have to feel overwhelming. You don't have to figure it out on your own. And if you're ready to talk about your next step, please reach out. I would love to help you build a plan that makes homeownership not just possible, but peaceful. So now that you've learned the 4 C's and how they impact the home loan process, the next steps, whether you're a home buyer or real estate professional, is for home buyers, start now. Pull your free credit report. Take a look at your current income and monthly obligations. Begin thinking about your savings goals. Even small steps today can make a big difference when you're ready to buy. For real estate agents, the more your clients understand the 4 C's, the smoother your transactions will be. By educating buyers early, you'll help them avoid surprises, reduce delays, and feel overall more confident throughout the entire process. If anyone has any questions or wants me to help get them mortgage ready, please reach out and let's get you scheduled for a call. Here's my information. This is my cell number, my email. You can find me on Instagram at Mrs. Risch. I am also on Facebook, Melissa Rischel. I hope this was helpful. And like I said, if you have any questions, please feel free to reach out to me anytime. I would be more than happy to walk you through this based off of your specific scenario. Thanks so much for your time. Have a great night.